Hi there, eToro. It is Tuesday, the 22nd of August, and that means it's time to take a look at what moved the markets last week. We currently find ourselves in the midst of a correction, and I do think it is a correction, not a collapse in stock prices. I'll talk about why more in a moment, but you can see that the NASDAQ fell from the high in July by about 8% through to the recent bottom that we saw, and the S&P 500 also fell, whilst not as much, which is quite normal. The S&P 500 tends to be less volatile than the tech-heavy NASDAQ 100, but that fell 5.5% more or less from the top in July through to the recent bottom. Now, there are a few reasons for this, but one of them being the fact that we have seen a very long, just about non-stop rally from this low in March, and if you zoom out even further, a non-stop rally from the bottom in October-November time frame last year. But we've also seen a few things that have scared investors a little bit recently. One of these being the fact the oil price has risen just about non-stop from the bottom that it saw in June to the high that we saw a week or two ago. Looking at the price of European natural gas, you can see that it has risen once again from the lows in July, mid-July, also from a price of about 24 euros to the current price, which is just about a doubling of the price of natural gas within that region. This is stoking fears that we're going to see more inflation driven by the price of energy. And this is not an unreasonable fear, because last year we saw that as winter approached, the price of energy escalated very, very quickly and drove up inflation in many countries. On top of this, one of the pieces of macro data that we saw last week was US retail sales. It's not so obvious from this chart here. It's a little bit more obvious from this chart here, but on trading economics, you can see that retail sales within the US rose by 0.7% month on month. The expectation was that they would rise by 0.4%, still a pretty strong reading, but they almost doubled that, rising by 0.7%. Now, the reason that this scares the market is the fact that consumers are still out there spending a hell of a lot of money, despite the fact that inflation is high. And this has contributed to the concerns about inflation that's a lot stickier than anyone had anticipated, which means that the Fed might continue increasing interest rates and keeping them higher for longer. Jumping across very quickly to US government bond yields. So these rise in tandem with expectations that the Fed is going to increase interest rates. And you can see once again in the same kind of time frame, yields bottomed roughly within the middle of July and have been climbing steadily since then. This is telling us that investors within the bond market, who tend to be very sophisticated investors with a hell of a lot of capital, expect that interest rates will continue to rise within the US. So the cost of capital will increase, and capital-hungry industries, for example, companies that need to grow very rapidly, will find it more expensive to grow and then therefore probably not grow by as much versus if the interest rate had been lower. Another key concern at the moment is the Chinese economy. So the Chinese economy is having a big problem with debt, particularly within the real estate area of its market, a very large part of its economy. And it's still fighting its way out of this economic crisis that's going on within China. We're also seeing a lot of opinions at the moment that the president of China is running the economy cold on purpose. He's trying to shake out a lot of the bad debt that exists within the economy, so that the economy is much healthier, and that he seems to be a very patient person. It doesn't matter what the political opinion is about him, because he is the leader of the only party really within China. The country has really battled to build confidence within its domestic market. People and companies don't seem to be spending as much as the government would like, and investors, international investors, are also quite concerned, so they're pulling resources out of that market at the moment. Concerns about the Chinese economy have a chain effect on a number of different areas of the market, one of those being commodities. So we have seen the prices of certain commodities, for example, some metals, drop off quite sharply over the past week or month. Now, I said at the beginning of this video that I don't expect that we're going to see an all-out collapse in stock prices within stock markets around the world. How can I justify that given all of the negative points that I just mentioned? The key reasons for me holding this opinion are, first of all, earnings have been very good, much better than had been expected coming into this year. Not just in the US, although I do have the US numbers up on screen. Hopefully you can read that, but in aggregates, earnings have exceeded estimates by 7.2%, which is below the 5-year average, but above the 10-year average. And so this is a relatively strong performance over the past 10 years, despite the economic conditions that we see out there at the moment. On top of this, even though inflation might end up being a little stickier at current levels than we had hoped, it still has dropped significantly from the highs that we were seeing last year. And interest rates are high and potentially going a little bit higher, but I don't think that anyone expects that they're going to jump as much as they did last year. So current consensus is that we are probably approaching peak rates for a lot of the West, the developed world within the West, and that at some point towards the middle of next year, rates will begin coming down again. Long story short, it does feel as though what we're seeing at the moment is the market taking a breather, and there are some challenges that the world needs to work through, but the overall context that companies are operating within, their microeconomies and the macroeconomy, things seem fairly healthy. They're going in the right direction. So moving on to this week, what big things could move the market through this week? Well, one of those things most certainly has to be NVIDIA's earnings, which are happening tonight, I believe. And this is because expectations are very high around NVIDIA's earnings. The company is being taken as a bellwether as to how the AI part of the economy, that thing that is driving a lot of growth within tech companies at the moment, is doing. NVIDIA is a fantastic company, a high quality company. Their share price has risen dramatically through this year, in part because they are a key element in just about any AI that's going to operate within the world right now. And their last earnings were just incredible, amazing earnings beat. However, the share price for the company is now priced, I would say, beyond perfection. They have become very expensive. So they not only need a beat today when they present their earnings, but they need to absolutely knock it out of the park. And they might, they may not, I'm not sure. If they don't, then I think that they will fall, their share price will fall, and they could bring a large part of the stock market down with them, particularly semiconductors, but also technology companies in general. Another key event through this week will be the Fed's Jackson Hole Symposium, and people will be prodding the Fed members to see if they can give up a little bit more information about their intentions with regards to rate hikes through the rest of this year. So if any information emerges from the symposium that is incredibly negative, I think that that could also end up moving the market, but I don't expect so. In terms of macro data hitting the market this week, I don't think that there's anything that's going to have a massive impact on the market, but if anything does, it's most likely going to be this initial jobless claims number that we see out of the US. Looking at eToro's earnings calendar quickly, you can see that there aren't many companies reporting. We're at the tail end of earnings season, so I don't think that there are going to be a lot of market-moving earnings reports going on through the next week or two, except for the one that I've already pointed out being NVIDIA tomorrow night. All right, that's for this week. I hope you have a good one. I'll talk to you soon. Goodbye.